Disclaimer.
This isn't just a rally, it's a controlled demolition of the world's reserve currency. While you were sleeping, the rules of the game were changed. This morning, January 28th, 2026, the CME Group pulled the kill switch, demanding a staggering $51,977 in cash just to hold a single silver contract. Why? Because the banks are trapped, the vaults are empty, and the price on your screen is officially a lie. Yesterday in Iowa, Donald Trump broke 40 years of protocol by calling a 10% currency collapse great. Today, the dollar is cratering to a 4-year low of 95.85. And for the first time in American history, the sitting Fed chair is facing a DOJ criminal investigation. The strong dollar era is over, and the smart money is running for the only exit door left, physical silver. The mainstream media wants you to focus on the $114 peak. They don't want you to see that physical silver in Tokyo is already trading at $140, and Shanghai is at $132. We are witnessing the great divorce, the moment paper promises separate from physical reality. Today, we reveal the math behind the 356 to 1 paper trap, the truth about the COMEX drainage, and why $114 silver is just the beginning of the most historic wealth transfer of our lifetime. Let's start with what happened in Iowa, because this is where the dominoes began to fall. For 4 decades, every American president has maintained the same unspoken rule: you never ever publicly cheer for a weaker dollar. It doesn't matter if you're a Republican or Democrat, if you believe in free trade or protectionism, if you're focused on manufacturing or services. The strong dollar policy has been the third rail of American economic diplomacy since Paul Volcker broke the back of inflation in the early 1980s. That policy represented more than just currency management. It was a promise to the world. It said, park your wealth here, finance our deficits, accept dollars for your oil and your electronics and your manufactured goods, and we will protect the value of that currency with the full faith and credit of the United States. That promise made the dollar the reserve currency. It made our treasury bonds the safest asset on earth. It made every central bank in the world willing to hold dollars as their primary reserve, even when we ran trillion-dollar deficits year after year. Yesterday, Trump tore up that promise on live television. He didn't hedge. He didn't use diplomatic language. He called a 10% currency collapse great for our exports. Within hours, currency traders around the world understood the message. The United States government is no longer committed to defending the dollar's value. We're now actively managing it downward. The dollar index, which measures our currency against a basket of major trading partners, immediately went into freefall. By this afternoon, it hit 95.85, a level we haven't seen since the economic chaos of 2022. But here's what makes this moment different from previous dollar weakness. This isn't happening because of a financial crisis or a recession or a policy mistake. This is happening because the President of the United States wants it to happen. He said so publicly. He gave the world permission to dump dollars, and they're taking him up on the offer. But the dollar collapse is only half the earthquake. The other half hit the Federal Reserve like a freight train. Jerome Powell, the man who controls our interest rates, who manages our money supply, who serves as the backstop for our entire financial system, is now the subject of a Department of Justice criminal investigation. The official reason? Something about building renovations at Fed facilities. The real reason? A power struggle between the executive branch and the central bank that's been brewing since Trump's first term. Think about what this means. The Fed is supposed to be independent. It's supposed to make decisions based on economic data, not political pressure. That independence is what gives our monetary policy credibility. It is what allows foreign governments to trust that we won't just print money to solve political problems. It's the institutional firewall that separates us from banana republics, where the president controls the printing press. That firewall is now under direct assault. When the DOJ opens a criminal investigation into the Fed chair, they're not just investigating building permits. They're sending a message. Get in line, or we'll find a reason to remove you. The market understands this. Bond traders understand this. Central banks around the world understand this. And they're all asking the same question. If the Fed isn't independent anymore, what backs the dollar? The answer, increasingly, is nothing. Not gold, not productivity, not the rule of law, just the political will of whoever occupies the White House. And when that person is actively cheering for currency depreciation, smart money starts looking for alternatives, which brings us to silver, the price that doesn't make sense. The COMEX exchange in New York closed this afternoon with silver at $114 per ounce. If you looked at your phone, checked the financial news, glanced at your brokerage account, that's the number you saw. $114. It sounds high. It sounds like silver is having a moment. But that number is fiction. While New York was posting $114, the Shanghai Futures Exchange was trading the same metal at $132. Tokyo was even higher at $140. The same ounce of silver, the same physical commodity, commanding prices that are $18 to $26 apart, depending on which side of the Pacific you're standing on. This isn't normal. This isn't a temporary arbitrage opportunity that traders will quickly exploit. This is a structural break in the global pricing mechanism. When two major exchanges can't agree on the value of a commodity within 20%, when physical buyers are willing to pay massive premiums over the official price, when the market fragments along geographic lines, you're witnessing the breakdown of price discovery itself. The Great Divorce has begun. Paper silver and physical silver are no longer the same asset. In New York, traders are exchanging contracts, digital promises that represent future delivery. In Shanghai and Tokyo, buyers are demanding immediate possession of actual metal, and they're willing to pay whatever it takes to get it, because they understand something that most Americans haven't grasped yet. The paper market is a house of cards built on promises that can't be kept. Here's the math that should terrify anyone paying attention. According to the latest data from the COMEX and global silver ETFs, there are approximately 356 paper claims for every single ounce of physical silver actually sitting in a registered vault. 356 to 1. Think of it like a bank that has $1 in the vault but has written $356 worth of checks. As long as everyone doesn't show up at the same time demanding cash, the system works fine. The bank stays solvent, the checks clear, life goes on. But what happens when people lose faith? What happens when Shanghai decides it doesn't want to roll over its futures contracts anymore, it wants actual delivery? What happens when Tokyo stops accepting New York's price and starts bidding for physical metal? What happens when industrial users, the companies that actually need silver for solar panels and electronics and AI servers, decide they can't trust the exchange anymore and start signing direct deals with mining companies? You get a bank run, not on dollars, on silver itself. And unlike a dollar bank run, where the Federal Reserve can print unlimited money to backstop the system, you can't print silver. You either have it in a vault or you don't. And right now, the vaults are draining at a rate that should have regulators sounding alarm bells. January is supposed to be a quiet month for COMEX deliveries. It's one of the off months, where traders typically roll contracts forward rather than demand physical settlement. Yet this January has become the 6th largest delivery month in the exchange's entire history. Traders are standing for delivery, forcing the exchange to actually produce metal instead of just shuffling paper contracts. The registered silver inventory, the metal that's actually available for delivery, has dropped 26% this month alone. 26% in 4 weeks, during what's supposed to be a slow period. This is what a slow-motion bank run looks like in the commodity markets. It's not dramatic. There are no lines around the building, no panicked depositors, just a steady, relentless demand for physical possession that the paper system was never designed to satisfy. Because the paper system was built on a lie. The assumption that most contracts would never be exercised, that traders would be happy rolling positions forward indefinitely, that actual physical delivery would remain a rare exception rather than a common demand. That assumption just died, and the CME knows it. That's why they pulled the kill switch this morning. That $51,977 margin requirement isn't about managing volatility. It's not about protecting market integrity. It's about protecting the major bullion banks that are sitting on losing positions they can't possibly cover. These banks sold more silver on paper than physically exists in available form. They made promises they cannot keep. They wrote insurance policies on a house that's already burning. And now, with the dollar collapsing, with physical demand surging, with the gap between paper prices and physical reality widening to historic levels, those banks are staring at losses that could wipe out their capital reserves and then some. So the exchange changed the rules overnight. They quadrupled the cash required to hold a position. They made it financially impossible for retail traders, for small hedge funds, for everyday Americans trying to protect their wealth to participate in what's coming next. If you're JP Morgan or HSBC with unlimited credit lines and Federal Reserve backing, $52,000 per contract is annoying but manageable. If you're a teacher who took early retirement and put savings into silver futures to hedge against inflation, you just got locked out of the market right before the real move begins. This is how the system protects itself, not through transparency, not through fair dealing, through raw exercise of institutional power. The rules changed because the wrong people were about to win, and the right people were about to lose. And when that happens in American finance, the game board gets flipped before the final score can be tallied. But here's what the CME can't control: physical reality. They can change margin requirements. They can alter contract specifications. They can make it expensive or impossible for small players to participate in the paper market. What they cannot do is change the fact that industrial demand for silver is rising, that mining production is flat, that the structural deficit between supply and consumption has been growing for over a decade. They can't change the fact that Shanghai and Tokyo no longer trust New York's pricing. They They can't change the fact that major technology companies are bypassing the exchanges entirely and signing direct offtake agreements with mining companies to secure future supply. They can't change the fact that every solar panel, every electric vehicle, every AI server cluster requires silver, and that requirement is only growing as the world electrifies and digitizes. Most importantly, they can't change what happened in Iowa yesterday. Trump's endorsement of a weaker dollar isn't just about exports, it's about a fundamental shift in how our government views the currency. For 4 decades, we've told the world, trust the dollar, it will hold its value. Now we're saying the dollar is a tool, and we'll use it however benefits us politically, even if that means devaluing your savings. That message has consequences. Central banks that hold trillions in dollar reserves are watching. Sovereign wealth funds are watching. Pension managers are watching. And they're all asking themselves the same question. If the United States is actively trying to devalue its currency, what should we be holding instead? The answer, for a growing number of institutional players, is physical commodities. Not paper claims, not ETF shares, not futures contracts that can be cash settled at the exchange's discretion, actual metal in actual vaults under actual control, because you can't devalue an ounce of silver with a press conference or a DOJ investigation. You can't print more of it to solve a political problem. It exists, or it doesn't. And right now, the people who need it are discovering that it doesn't exist in the quantities the paper market promised. That's the great divorce. That's what's driving the price gap between New York and Shanghai. That's why the CME is panicking and changing rules in the middle of the game. We're watching the moment when paper promises separate from physical reality. When confidence breaks down, when the system that has managed commodity prices for half a century reveals itself to be built on leverage and assumptions rather than actual inventory and honest dealing. This is only the beginning. The $114 you see on your screen isn't the end of the story. It's the first crack in a dam that's about to break. Now let's talk about what's happening behind the scenes, because the real story isn't on your Bloomberg terminal or your brokerage screen. It's in the vault data, in the delivery statistics, in the unprecedented legal assault on the Federal Reserve that's unfolding right now in Washington. Here's something that should send chills down your spine. While silver was touching $114 this morning, gold simultaneously broke through $5,280 per ounce. That's not just another all-time high. That's gold screaming a warning that something fundamental has broken in our monetary system. And the trigger for that move? The Department of Justice escalation against Jerome Powell. Let me be crystal clear about what's happening here. The DOJ aren't investigating the Fed Chair because they genuinely care about building renovation contracts or construction permits. This is a power play dressed up as a criminal investigation. This is the executive branch telling the central bank, either you accommodate our policy preferences or we'll find a legal pretext to remove you. The official story is laughable on its face. According to the subpoena that leaked to the financial press this morning, federal prosecutors are examining whether Powell properly disclosed relationships with contractors involved in Federal Reserve facility upgrades. They're looking at whether competitive bidding processes were followed. They're investigating whether any personal relationships influenced procurement decisions. Does that sound like something that would normally warrant a criminal investigation of the most powerful central banker in the world? Or does it sound like a fishing expedition designed to find something, anything, that could be used as leverage? The market answered that question definitively. Within minutes of the subpoena becoming public, gold futures surged $300. Treasury yields jumped 40 basis points as bond traders started pricing in the possibility that the Fed might lose its independence entirely. The dollar, already weak from Trump's Iowa comments, accelerated its decline. And silver, which had been consolidating around $110, punched through $114 like it wasn't even there. This is what a constitutional crisis looks like in the financial markets. Not tanks in the streets, not dramatic pronouncements from the Supreme Court. Just a quiet, methodical dismantling of the institutional firewall that separates monetary policy from political pressure. And the markets are reacting exactly the way you'd expect when the credibility of the world's reserve currency comes into question. Think about what message this sends to foreign central banks. The Bank of China holds over $1 trillion in U.S. Treasury securities. The Bank of Japan holds another trillion. The European Central Bank, the Swiss National Bank sovereign wealth funds across the Middle East and Asia, they all have enormous dollar positions built on one fundamental assumption, that our monetary policy is independent, professional, and not subject to political whims. Now, imagine you're a central bank governor in Beijing or Tokyo or Frankfurt. You're watching the President of the United States openly advocate for currency depreciation. You're watching the Department of Justice open a criminal investigation into the Fed Chair for what appears to be purely political reasons. You're watching the institutional checks and balances that made the dollar the world's reserve currency get systematically dismantled. What do? Do you sit there and hope this blows over? Or do you start quietly diversifying out of dollars and into assets that can't be devalued by executive order or DOJ subpoena? The answer is showing up in the delivery data, and it's absolutely unprecedented. According to COMEX statistics published this afternoon, January 2026 has now officially become the 6th largest delivery month in the exchange's entire history. Let that sink in. January is supposed to be a sleepy month. It's one of the designated off months, where most contracts roll forward rather than settle for physical delivery. Yet this January, institutional traders are standing for delivery in numbers we've only seen 5 times before. And those 5 previous occasions? They all happened during major financial crises. March 2020 when COVID shut down the global economy, September 2008 when Lehman Brothers collapsed, November 1997 during the Asian financial crisis. These are the only times we've seen delivery demand at current levels. What does it tell you when calm professional institutional traders, the hedge funds and asset managers and family offices that are supposed to be sophisticated and patient, suddenly start demanding immediate physical possession during what should be a routine month? It tells you they don't trust the system anymore. It tells you they've done the math on the paper-to-physical ratio and decided they'd rather have metal in a vault than a contract that promises future delivery. And they're right to be worried, because the vault inventory numbers are genuinely terrifying. The COMEX tracks 2 categories of silver, eligible and registered. Eligible means metal sitting in an exchange-approved vault that could theoretically be delivered against a contract. Registered means metal that's specifically allocated for delivery and is currently backing outstanding futures positions. Right now, registered silver inventory has collapsed by 26% in just 4 weeks. That's not a slow decline. That's not normal seasonal variation. That's a bank run in slow motion. Every day, more metal gets pulled out of the registered category and either moved to eligible or leaves the exchange entirely. The institutions that own the silver are systematically reducing their exposure to the COMEX system. Why? Because they can do basic arithmetic. According to data compiled from COMEX records, global silver ETF holdings, and outstanding derivatives positions, there are currently approximately 356 paper claims for every physical ounce in a registered COMEX vault. 356 to 1. That's not a market. That's a Ponzi scheme with a silver ticker symbol. Let me put this in terms anyone can understand. Imagine your bank operates with a 356 to 1 leverage ratio. For every dollar they actually have, they've written checks totaling $356. As long as most people don't cash their checks at the same time, everything works fine. The bank stays solvent, accounts balance, life continues. But what happens when people start getting nervous? What happens when rumors spread that the bank might not have enough cash on hand? What happens when just 5% of depositors decide they want their money right now instead of next month or next year? You get a bank run. The doors close, the checks stop clearing, and the people who waited, who trusted the system, who believed everything would work out fine, they're the ones left holding worthless paper, while the smart money walked away with the actual cash weeks earlier. That's what's happening in the silver market right now. The smart money, the institutional players with research teams and risk management departments and sophisticated models, they're walking away from paper and demanding physical. They're looking at the same 356 to 1 ratio that you're looking at, and they're doing the only rational thing, getting their metal out before everyone else figures out the game is rigged. And here's what makes the situation even more explosive. Unlike a regular bank run, where the Federal Reserve can print unlimited dollars to backstop the system, you cannot print silver. It has to be mined from the ground at significant cost and effort. It takes years to bring a new mine into production. You can't just decide to make more silver the way you can create more dollars with a keystroke. The physical supply is what it is. According to the Silver Institute's latest global supply and demand report, we're mining about 820 million ounces per year. Industrial demand alone is consuming roughly 900 million ounces. That's an 80 million ounce deficit before we even account for investment demand, jewelry fabrication, or government stockpiling. For years, that deficit was filled by recycling and by drawdowns from above-ground stockpiles built up over decades. But what happens when those stockpiles run dry? What happens when recycling can't keep up with consumption? What happens when investment demand surges at exactly the moment supply is constrained? You get what we're seeing right now. Physical buyers in Shanghai paying $132, Tokyo paying $140, New York stuck at $114, because the paper market can't acknowledge the real clearing price without admitting the entire leverage structure is built on sand. But here's where it gets really interesting, and this is the part the mainstream financial media absolutely refuses to discuss. Major industrial users are starting to bypass the exchange system entirely. According to recent SEC filings and industry reports, companies like Samsung, LG, and several unnamed solar manufacturers have begun signing direct offtake agreements with mining companies. These aren't normal supply contracts. These are multi-year agreements, where the buyer commits to purchasing production directly from the mine, often at prices significantly above current COMEX levels. They're essentially admitting that they don't trust the exchange to deliver metal when they need it, so they're willing to pay a premium to secure supply outside the traditional market structure. Think about what that means. When Samsung decides it can't rely on the COMEX to provide silver for its electronics manufacturing, when solar companies start locking up mine production years in advance, when industrial users with billion-dollar supply chains decide the exchange can't be trusted, that's not a vote of no confidence. That's a five-alarm fire, and it's removing supply from the market permanently. Every ounce committed to an offtake agreement is an ounce that will never make it to the COMEX. It's an ounce that can't be leveraged 356 times on paper. It's an ounce that goes straight from the mine to the factory, bypassing the entire financial system that's supposed to facilitate price discovery and efficient allocation. The Great Divorce isn't just happening between paper and physical prices. It's happening between the financial market and the real economy. Industrial users are waking up to the reality that the financialized commodity system, the futures and options and ETFs that Wall Street built, cannot deliver actual metal when push comes to shove. So they're going around it. Meanwhile, central banks are doing their own calculation. Gold holdings among official institutions have been rising for 15 consecutive quarters, according to the World Gold Council. Central banks added over 1,000 tons of gold to their reserves last year alone, the highest annual increase in decades. And while silver isn't typically held as a monetary reserve, the buying pattern tells you everything you need to know about institutional faith in paper currencies. They're diversifying. They're reducing dollar exposure. They're accumulating physical assets that can't be devalued by a subpoena or a press conference or a political crisis in Washington. And they're doing it quietly, methodically, before the general public figures out what's happening. Because here's the thing about bank runs and currency crises. They move slowly at first, then all at once. For months or even years, the smart money trickles out. Institutional players quietly reduce exposure. Warning signs flash that most people ignore, and then one day, seemingly out of nowhere, everything breaks. We're in the slowly at first phase right now. The warning signs are everywhere. The paper to physical ratio is unsustainable. The vault drainage is accelerating. The DOJ investigation is undermining Fed credibility. The dollar is weakening with presidential blessing. Industrial users are bypassing exchanges. Delivery demands are hitting crisis levels during a supposedly quiet month. But most people aren't paying attention. They see $114 on their screen and think silver is expensive. They don't see 132 in Shanghai or 140 in Tokyo. They don't understand the 356 to 1 leverage. They don't realize the registered inventory is collapsing. They don't connect Trump's Iowa comments to the structural break happening in commodity markets. The ignorance won't last much longer, because we're rapidly approaching the all-at-once phase, the phase where the gap between paper and physical becomes too obvious to ignore, where the leverage unwinds not over years but over days, where price discovery happens not through orderly exchange trading but through panic and forced liquidation, and the brutal realization that promises are not the same as possession. The $114 you're seeing right now, that's not the price of silver. That's the price of a promise about silver. And anyone who's studied history knows that when the system breaks, promises become worthless overnight while physical assets retain their value. The proof is in the numbers. The 26% inventory decline, the 6th largest delivery month ever, the 356 to 1 paper trap, the Shanghai premium, the Tokyo premium, the industrial offtake deals, the DOJ subpoena driving gold to 5,280. Every data point confirms the same conclusion. The system is breaking and the smart money is running for the exits. The only question left is whether you'll recognize what's happening before the slowly at first becomes all at once. Because when that transition happens, there won't be time to position. There won't be opportunity to prepare. The exits will be jammed, the vaults will be empty, and the paper promises will reveal themselves for what they've always been. A beautifully constructed lie that only worked as long as everyone pretended to believe it. Now, let's talk about where this goes next. Because if you understand the mathematics of what's unfolding, the path forward becomes disturbingly clear. And it all comes down to one critical number, $118. Here's why that specific price point matters. Silver is currently trading at $114 in New York, but it's been testing resistance at 118 repeatedly throughout the day. That level isn't arbitrary. It's not a psychological round number. It's the mathematical pivot point where the entire leverage structure of the paper market becomes mathematically unviable. At $118, the margin requirements on short positions become so severe that the smaller bullion banks start facing liquidity crises. At $118, the carry cost on rolled futures contracts exceeds the premium show-ye traders were hoping to capture. At $118, the premium between physical and paper becomes so wide that arbitrage traders can no longer explain it away as temporary dislocation. Most importantly, at $118, the 26% inventory drawdown we've seen this month accelerates into a full-scale drainage. Because at that price, every industrial user, every investor, every smart money institution that's been sitting on the fence makes the same calculation. Better to pay up now than to be left holding worthless paper later. The Federal Reserve is scheduled to hold a press conference at 2:30 p.m. Eastern today. Jerome Powell is supposed to address the DOJ investigation, provide guidance on interest rate policy, and reassure markets that everything remains under control. But ask yourself this: what can he possibly say that would restore confidence? How does he explain away a criminal investigation into his conduct while simultaneously maintaining that the Fed remains independent? How does he push back against presidential pressure for a weaker dollar without confirming that political considerations are now influencing monetary policy? He can't. There's no speech, no carefully crafted statement, no diplomatic language that threads that needle. Which means the 2:30 p.m. press conference is likely to accelerate the crisis rather than contain it. And if silver is anywhere near $118 when Powell starts speaking, the move through that level could be violent. Because here's what happens when 118 breaks. The algorithms kick in. High-frequency trading systems that have been programmed to recognize technical breakouts start buying. Commodity trading advisors who follow momentum strategies add positions. The hedge funds that have been shorting silver based on the assumption that the paper market would hold get forced to cover. And most importantly, the remaining holders of paper contracts decide they'd rather have physical metal than wait to see what happens next. That cascade pushes prices toward the next mathematical target. And this is where the calculation gets really interesting. Gold is currently trading at $5,280 per ounce. Silver is at $114. That gives us a gold to silver ratio of roughly 46 to 1. In other words, it takes 46 ounces of silver to equal the value of 1 ounce of gold. But here's the thing about that ratio. It's historically elevated. Over the past century, the average gold to silver ratio has been closer to 60 to 1, with periodic compressions down to 30 or 40 to 1 during times of monetary stress. During the Hunt brothers' silver squeeze of 1980, the ratio briefly hit 15 to 1. During the inflationary crisis of the late 1970s, it averaged around 30 to 1. Right now, with the dollar under assault, with Fed independence being questioned, with physical markets divorcing from paper, we're seeing exactly the kind of monetary stress that drives the ratio lower. And if history is any guide, a move toward a 40 to 1 ratio isn't just possible, it's probable. Do the math with me. If gold stays at $5,280 and the ratio compresses to 40 to 1, that puts silver at $132 per ounce. Interestingly, that's exactly where Shanghai is trading right now. The physical market in Asia has already priced in the ratio compression that New York is still refusing to acknowledge. But what if gold doesn't stay at $5,280? What if the DOJ investigation, the dollar weakness, the breakdown of institutional credibility drives gold higher? What if we see 5,500, 6,000? The levels that gold analysts have been predicting for years based purely on monetary expansion and deficit spending. If gold hits $5,500 and the ratio compresses to 40 to 1, silver trades at $137.50. If gold reaches $6,000, we're looking at $150 per ounce. These aren't wild speculations. These are mathematical consequences of the monetary instability that's unfolding right now in real time. The target that keeps coming up in technical analysis is $127.50. That's where silver lands if gold holds current levels and the ratio moves to a historically normal 40 to 1. It's also the level where the next major resistance sits based on Fibonacci extensions from the 2020 low to the current high. Multiple analytical frameworks, from technical to fundamental to historical ratio analysis, all point to the same number. 127.50 isn't the end of the move. It's the next major inflection point, the level where we pause, consolidate, and then decide whether this becomes a full-scale monetary crisis or just another volatility spike that eventually reverts to mean. But here's what should worry you about that potential pause. During the consolidation, during the period where prices are settling into a new range, that's when the real wealth transfer happens. That's when the people who understood what was coming and positioned accordingly lock in gains. That's when the people who stayed in cash or stayed in paper assets watch their purchasing power evaporate. That's when the difference between being early and being right becomes blindingly obvious, and that wealth transfer is already underway in ways most people don't see. Remember those industrial offtake agreements we talked about? Samsung signing multi-year contracts directly with mining companies? That's not just about securing supply. That's about locking in prices before the real move begins. Think about Samsung's calculation. They know they need silver for electronics manufacturing. They know the deficit between supply and demand is structural, not temporary. They know the paper market is leveraged 356 to 1 and mathematically unsustainable. So instead of waiting to buy silver at $127 or $150 or $200, they're signing agreements now that lock in prices closer to $100 for the next 5 years. That's a sophisticated corporation with billions in revenue and world-class analysts making a very specific bet that silver is going significantly higher, that the exchange system can't be trusted to deliver physical metal, and that securing supply now at a premium to current prices will look like genius when the full extent of the shortage becomes apparent. They're not alone. According to recent industry reports, solar manufacturers are in the middle of a bidding war for mine production that hasn't even been extracted yet. They're offering terms that lock up future supply before it leaves the ground. They're bypassing the entire exchange system and going straight to the source because they've done the same math everyone else is slowly waking up to. Every ounce committed to these offtake deals is an ounce that exits the tradable market forever. It's an ounce that can't be leveraged on paper. It's an ounce that won't show up on the COMEX as available inventory. And when you're starting from a position where registered stocks have already dropped 26% in a month, when the leverage ratio is already 356 to 1, when physical demand is already exceeding supply by 80 million ounces per year, every ounce that exits the tradable market accelerates the inevitable collapse. This is what the end of a commodity bubble looks like, except in reverse. Usually, bubbles pop when too much supply comes online and prices crash. This is the opposite scenario. This is what happens when decades of financialization and paper leverage finally collide with physical reality, when the promises can't be kept, when the contracts can't be settled, when the people holding real assets refuse to accept paper substitutes. The Federal Reserve, the Treasury Department, the COMEX, the bullion banks, they all understand this dynamic. They've known for years that the paper market was over-leveraged. They've known the leverage was building systematic risk. They just assumed they could manage it indefinitely through margin adjustments, contract modifications, and occasional delivery disruptions that could be explained away as temporary operational issues. What they didn't anticipate was a president who would actively undermine dollar credibility. They didn't anticipate a DOJ investigation that would call Fed independence into question. They didn't anticipate Shanghai and Tokyo deciding they were done accepting New York's prices. They didn't anticipate industrial users bypassing the exchange system entirely. All of those assumptions, all of those carefully managed risk parameters, they're collapsing simultaneously. And when multiple stress factors hit a leveraged system at the same time, the math stops being linear. It becomes exponential. The slowly at first becomes all at once. So let's talk about what you actually do with this information, because awareness without action is just expensive entertainment. The first thing to understand is that we're no longer in a normal investment environment. This isn't about finding the best yield or picking the hottest stock or timing the market perfectly. This is about value migration. This is about recognizing that the rules are changing and positioning accordingly before the change becomes obvious to everyone. Value migration means moving wealth from assets that can be devalued by political decisions into assets that have intrinsic worth independent of government policy. It means reducing exposure to paper promises and increasing exposure to physical possession. It means accepting that in a world where the executive branch is attacking the Fed, where the dollar is being deliberately weakened, where commodity markets are fragmenting along geographic lines, traditional portfolio theory doesn't apply anymore. The goal isn't profit in the conventional sense. The goal is preservation. The goal is making sure that when the dust settles, when the paper market has unwound, when the leverage has collapsed, you're holding assets that still have value rather than claims on a system that no longer functions. For some people, that means physical silver. For others, it might mean gold or real estate or productive assets or businesses that generate real cash flow. The specific vehicle matters less than understanding the principle. In a crisis of institutional credibility, tangible assets outperform financial claims. And make no mistake, that's what this is. A crisis of institutional credibility. When the president undermines currency stability, when the DOJ investigates the Fed chair, when major exchanges have to quadruple margin requirements overnight, when physical prices diverge from paper prices by 20% or more, you're watching the institutional framework that has governed global finance for 70 years begin to break down. That breakdown doesn't happen cleanly. It doesn't follow a predictable timeline. Markets can remain irrational longer than you can remain solvent, as the saying goes. But the direction is clear. The mathematics is clear. The inventory data is clear. The institutional behavior is clear. Everything points to the same conclusion. The paper market for silver is in the process of collapsing, and when it does, the price discovery mechanism will shift entirely to physical markets where supply is constrained and demand is accelerating. $114 is just the beginning. 118 is the critical breakpoint. 127.50 is the mathematical target based on ratio compression. But the real question isn't where silver goes in the next week or month. The real question is whether you understand what this price action represents about the broader monetary system. Because silver is the canary in the coal mine. It's the most leveraged major commodity. It's the market where the gap between paper and physical is most extreme. It's where the supply-demand imbalance is most acute. When silver breaks, when the paper market can no longer suppress the physical reality, that's not just about one commodity. That's a signal that the entire financialized system built on leverage and derivatives and promises is vulnerable. The Wednesday reset isn't about silver hitting $114. It's about the United States government abandoning the strong dollar policy. It's about the Department of Justice weaponizing criminal investigations against the Federal Reserve. It's about Shanghai and Tokyo refusing to accept New York's pricing. It's about the institutional framework of the post-Bretton Woods monetary system cracking under the weight of its own contradictions. Silver is just the asset class where those contradictions become visible first, where the leverage is highest, where the disconnect between paper and physical is most obvious, where the math is simplest and most brutal. 356 paper claims for every physical ounce can't be sustained when people start demanding delivery. So watch what happens at 2:30 p.m. when Powell speaks. Watch whether silver holds 118 or breaks through. Watch whether gold continues toward 5,500. Watch whether the dollar index keeps falling or finds support. But more importantly, watch whether you're positioned for what comes next. Because the Wednesday reset isn't a one-day event. It's the beginning of a much larger transition. The transition from paper to physical, from promises to possession, from trust in institutions to trust in tangible assets, from a world where leverage and financial engineering created the illusion of infinite supply to a world where physical constraints reassert themselves with mathematical precision. $114 isn't a death warrant for the dollar because of the price itself. It's a death warrant because of what the price reveals. That the system is broken, that the leverage can't be sustained, that the promises can't be kept, that the emperor, as they say, has no clothes. And once that becomes obvious to everyone, once the slowly at first becomes all at once, the only question that matters is whether you saw it coming and acted accordingly. The numbers are there. The data is there. The warning signs are everywhere. What you do with that information is the only variable left to determine,